Alright, let's talk about something called smart money concepts, or SMC for short. Now, I know what you're thinking. It sounds complicated, maybe a little intimidating, like something only Wall Street pros with fancy degrees would understand. But here's the secret. It's actually not that hard once you break it down. Imagine for a second that the financial markets like stocks or crypto are a giant ocean. Most of us are like tiny fish, swimming around, trying to catch a small wave. But then you have the giant whales. Big banks, huge financial institutions, hedge funds. These are the players with billions, even trillions of dollars. They are the smart money. When they move, they don't just catch waves, they make them. SMC is simply the art of learning to spot the footprints these whales leave behind in the market. Why should you care? Because they move the market. Their massive orders cause huge, sudden price spikes or drops that you see on the charts. If you trade like everyone else, using the same old indicators, you'll likely get caught in the whale's wake and lose money. Okay, first up is the break of structure or BOS. This is probably the most fundamental and easiest concept to spot. Think of it like walking up a staircase, each step higher than the last. Higher highs and higher lows. That's an uptrend. A BOS to the upside is taking a step even higher than your previous highest step. Imagine price going up. It hits peak A, pulls back a little, then rallies and shoots past peak A. New higher peak. That blast through peak A? That's your BOS. Same logic in a downtrend. Price falls to a low point, falls again, breaking below the previous low point. That's a bearish BOS. Signal. Sellers in control, pushing price down. Now that we understand how to identify the market's direction with a break of structure, let's find the footprint of the smart money itself. This is where the order block, or OB, comes in. An order block is the last opposing candle right before a big explosive move that causes a break of structure. If the market is in an uptrend and a huge green candle shoots up and breaks a previous high, the order block is the last red candle right before that explosive move. Think about why this happens. Big institutions can't just place one giant order to buy or sell billions without moving the price. To accumulate a large buy position, they might first place a bunch of sell orders to drive the price down slightly. Then, once the price is a little lower and there are plenty of sellers, they unleash their massive buy orders, absorbing all those sell orders and sending the price rocketing up. That final little down candle before the explosion, that's the footprint of their manipulation. That's the order block. It represents a significant point of interest where a huge volume of orders was injected into the market by institutional players. We've got the trend direction with BOS and a potential entry zone with the order block. Now, let's add another layer of confirmation with our third concept, the fair value gap, or FVG. This one sounds the most technical, but the idea is actually very straightforward. A fair value gap is an inefficiency or an imbalance in the market that's created when the price moves very quickly and aggressively in one direction. Look for a pattern of 3 consecutive candles. A fair value gap occurs when the low of the first candle and the high of the third candle do not overlap. The empty space in the middle, within the body of the big second candle, is the FVG. Think of it as a vacuum. The price moved so fast it skipped a fair negotiation. The market hates imbalances and likes to be efficient, so it will often return to FVG zones to fill the gap and rebalance before continuing. Alright, so we've covered the 3 core components: break of structure, order block, fair value gap. Now for the fun part, let's see how they all work together in a real-world trading scenario. Imagine you're looking at a chart and the price has been trending downwards. Then you see a strong move upwards that breaks above the most recent lower high. Ding, ding, ding. That's your first signal, a break of structure. This is a potential change in character, suggesting the trend might be reversing from bearish to bullish. This is where you stop thinking about selling and start looking for a reason to buy. Now that the market has shown its intention to potentially move higher with that break of structure, your job is to find the origin of that powerful move. You're looking for the last down candle, the red one, before the massive green candles took over. You find it, and you mark out that entire candle's range, from its high to its low. This is your bullish order block. You inspect the explosive move that came out of that order block. You look at the candles and notice a big impulsive green candle that left a gap. You found a fair value gap. Often this FVG will be sitting right inside or just above your order block. This gives you an even more refined zone to watch. Instead of targeting the entire order block, you can now focus on the FVG as your sweet spot for an entry. So here's the complete plan. It's great to know how to spot these patterns on a chart, but it's even more powerful to understand why they work. The logic behind smart money concepts is rooted in market structure and the behavior of its largest participants. Markets are dominated by institutions with deep pockets. They need liquidity to execute enormous orders without moving the price against them. Liquidity equals sign availability of buyers and sellers at price levels. This is where engineering liquidity comes in. Smart money pushes price to where retail orders sit. They may push price down to break that low, triggering stop losses. A stop loss on a buy becomes a market sell order. Smart money uses those sell orders to fill massive buys, then pushes price up. Retail traders get left behind. As powerful as these smart money concepts are, they are not a magic bullet. Like any trading strategy, there are common pitfalls that beginners and even some experienced traders fall into. The first and most common mistake is seeing these patterns everywhere. It's crucial to remember that context is everything. A perfect-looking order block in the middle of choppy sideways price action is far less meaningful than one that directly caused a clean break of structure in a clear trend. Another huge mistake is a lack of patience. The classic smart money concept setup requires you to wait for the price to return to your point of interest, the order block or fair value gap. Many beginners get impatient. They see the price moving away and feel the fear of missing out, FOMO. To really appreciate what smart money concepts bring to the table, it helps to compare them to what most people learn first, which we can call traditional retail trading. This traditional approach often relies heavily on lagging indicators like the relative strength index, moving average convergence-divergence, moving average crossovers. The problem with these indicators is that they are, by their very nature, lagging. They only tell you what has already happened. An RSI showing oversold doesn't cause the price to go up. The price going up causes the RSI to move out of the oversold region. Traditional chart patterns like head and shoulders, double tops, triangles. While these patterns can be useful, they are so well known that they can easily be exploited. They can then manipulate the price to trigger those stops before reversing the market. So let's bring it all home. We've journeyed through the core ideas of smart money concepts, and hopefully the fog has cleared. It all boils down to a simple premise: follow the big money. We started with the break of structure, our compass for determining the market's true direction. Next, order block, the telltale footprint left by institutions. That last opposing candle before a massive structure-breaking move is not a random blip. Finally, fair value gap, a layer of precision. These imbalances from swift price moves act as magnets for price. Weave break of structure, order block, fair value gap together for a robust, repeatable framework. You're no longer just guessing or relying on lagging indicators. You're building a narrative about what big players are doing. This is your new toolkit. Practice spotting these concepts on a chart. Be patient. Mastering this takes time. Understanding the why unlocks deeper trading insight.